Hey, everybody, welcome to the podcast. Today, you are getting behind the scenes look into one of my guest experts that I have for my clients and you all here on YouTube on the podcast. Today, I have the pleasure, the honor to working with and introducing you all to Leesa Myers. She is a tax strategist that will help you minimize taxes and legal burdens and help you grow your business so that you can have more profit in your pocket as you grow and expand your speaking, your coaching, and your other business. So welcome, Leesa. I'm so happy that you are here. Go ahead and
Thank you,
introduce
Amanda. I
yourself real quick.
appreciate it. Sure.
Yeah.
So I'm basically a born entrepreneur. I've been doing business for over 30 years and a lot of times badly. So I had to reorganize my business when I seen this concept as well. So I came from the beauty industry and then had a school where I helped nail technicians build their business. So I've been helping people for probably over a good 20 years with businesses, but now within the last few years, understanding what the rich do that we don't understand and taking advantage of that.
Right on. Let's tell us what the rich people do. So go ahead and share your screen. I know you have an amazing presentation for us. And then everybody watching, as she's sharing her screen, I'll get you connected with Leesa as well if you have questions. And she is going to go through her amazing presentation. And I hired her a few months ago and we got all this set up.
Yes. So first of all, my company is the Business Owners Advocate Incorporated. I am a corporate strategic advisor. So I want to make the first disclaimer is that I am not a tax attorney or an accountant or a CPA or a lawyer. I contract with a company so that they oversee and make sure that I've got everything and I'm able to use their documents that were created by lawyers and CPAs and so forth. So again, this is what the rich has been doing that most of us don't understand. And let's get started. Okay. So this is basically kind of the agenda type thing that I'm going to discuss is the difference between filing versus structuring, various options, the critical viewpoints that you need to understand when you're in business, and strategies behind that. So first of all, most of the time when we go into business, we will just go ahead and do it yourself. And I did this for many, many years. So I'll get on the state website. I'll file with the state. The state recognizes that I have a business. You have a certificate of organization. Usually the state will provide a generic one and so forth. You apply for an EIN number. So in the United States, when you apply for an EIN, that triggers the IRS that you are now a business and hopefully will start receiving some money from you. Now, understand one thing in the United States, I'm not sure in other countries, but in the United States, the IRS is a tax collection company for the government. So the IRS is not your friend. They are there to find out where money is hidden and where they can find more money. Okay, so we always say, if ever you talk with an IRS agent, you answer the questions, but you never volunteer anything. Okay. By filing with the state and just doing this, there really is no protection whatsoever. Now, when you're structuring a business, again, the state will recognize that you have that business. You'll have a certificate of organization. You need operating agreements. How is this business going to be running? You need to have corporate minutes. So if you've been in business and you're not holding corporate minutes, then that can be held against you. Okay, the IRS, the state wants to know that you're running your business as a business, not as a hobby. Asset control and cash flow, the EIN to trigger the IRS, as well as now you're going to start acting as a business, which activates that protection. These are the different available structures. These are the ones we're going to talk about today. So the first thing is, what's the difference between a C corporation and an S corporation? So the IRS came a few years back and started with S corporations. The reason they brought those into fruition was because they wanted to collect more money. And it was really triggered against the health professionals, lawyers, doctors and so forth, because they said they could not separate themselves from the business. Therefore, they needed to be an employee. So an S corporation is basically small business, is what it stands for. And a C corporation is a classic corporation. Basically, it came over with the Pilgrims. So it's been around. And a lot of times we have this misconception that if you are a C corporation, then you're supposed to be, a big, 100 or 500, type company with lots of employees. And that's not true. One thing that the C corporation allows you to do is have a fiscal year, which allows tax strategies. A fiscal year means that you can start any month of the year versus January. So you can start March or April. We like to start the basically your quarters. So April 1st, July 1st, October 1st, and so forth. You cannot do that with the S corporation because the S corporation has to follow the employee. So again, with an S corporation, you are a W-2 with your business. So let's talk about taxes. Okay. Yeah. So when you work for a company and you're an employee, you are paid your wages and then all the taxes are deducted and then you pay your expenses, right?
Right.
Well, when you start a business, our idea is to pay less taxes. So you go into business with the idea that the money comes in, the income comes in, the expenses go out, you pay taxes on what's left over. However, with the S corporation, the money comes in, you have to be an employee. So now you are again on the top of that tax bracket. And then if you have a profit, then it's called passive law or passive income. And it's very minimal expenses that you can use against them on that. So wow. A lot of times companies are worried about double taxation, and we have ways of avoiding that, and not avoiding, but minimizing so that there's not that. So with a C corporation, a trust can own your corporation. It cannot own an S corp. You can also have fringe benefits for the directors and so forth, like insurance, health, life, and so forth, where in an S corporation is considered a fringe benefit and it will be taxed. And then again, a C corporation is active income, where a S corporation is passive if there's any profit. Now, what about single member LLCs and multi-member LLCs? So a lot of times they'll be, well, I'm an entrepreneur. I'm a sole person, sole proprietor, and that. So I'm just going to sign up as a single member LLC. Okay. Well, the problem with the single member LLC and a multi-member LLC is the protection that it affords. The 1040, so an LLC is a pass-through company. Any profits in that pass through to you on either a 1040, or if you have members or partners, then it's a K1. Okay, with that being said, a trust can be a member of a multi-member LLC, which can create continuity. We'll talk a little bit about that. The state recognizes the business setup as you, right, as a single member, where with a multi-member, it's a standalone. We want arm's length for that protection.
That's good.
You have limited expenses when you are a single member. They look at those expenses because you are you. Right? They can consider you an alter ego. And for that, then they can disallow a lot of those expenses that you want to take. Home-based businesses are one of the highly, those that the IRS looks at, because you say, well, I've got a square footage of my home, and so I'm going to deduct a certain amount of expenses and that. Right. The IRS is going to come in and say, okay, that room that you're using, do you ever go in and watch TV? Do you ever go in and play video games? Do you ever go in, or is it strictly for business alone? Right.
Right.
And if they can make that so that you're not there 100% for business, then they can disallow those expenses. Okay.
Right.
With a multi-member, we have that standalone. You can take full business expense deductions. And again, it gives you that arm's length protection where there really is no protection if it's a single member. And we have asset transfer availability.
That's cool.
So the common thread is to minimize your taxes and minimize your legal exposure. One of the things with Mitt Romney got in trouble as the U.S. Senator in Utah because he was stated that he paid less taxes than his executive secretary, his admin, right? And that's the reason behind that is he's not an employee. He controls his businesses so that the businesses are paying for those expenses. If you've ever read Robert Kiyosaki, Rich Dad Poor Dad, or if you've ever heard him talk,
yes,
right?
Yes.
So he will tell you that he does not pay for anything unless it's an asset.
Right.
Right. So my husband had a boss that wanted to buy an airplane. And he had rental properties. So he put a mortgage on a rental property, used that income to buy the airplane. So that LLC owned the airplane, was able to depreciate it if he used it. Okay.
Smart.
So you want to make sure that you're taken care of. So let's talk about this house. When you have a team that's not communicating, and that team can be at the front door, you have an accountant or a CPA. At the back door, you have your corporate lawyer or your business attorney, right? On one side, you have a estate planner, and on the other side, you have your management team. They're all talking from their own perspectives. The CPA and the accountant is making sure that your books are taken care of so that you are paying the right amount and the amount of taxes that you need to pay. Your business lawyer is making sure that you've got all your I's dotted and your T's are crossed. And your estate planner wants to know what happens if you pass away. What's going to happen to your business? What's the succession plan? Your management team, if you don't have a good management team, then that can ruin a business. So your key factors, your essential advisors you need is your management, lack of adequate management. And that could be just you, right? That could be you. But if you're not taking care of your business, they always talk about working on your business, not always in your business. Again, Robert Kiyosaki talks about having the 4 quadrants, and he'll talk about, are you a employee? Are you self-employed, which means that you created a job for yourself because you can't step away from it. Are you an investor or are you a business owner? And one of those aspects, right?
Right.
The CPA, we already talked about cash flow, estate planning, that succession, and then of course your attorney. I'm going to show you this quick. It's just 5 minutes, but it'll show you kind of what we do.
Okay.
Let me know if you can't.
Small businesses who work with the public and want to increase their liability protection and available tax benefits. The first layer in this protective strategy is a corporation, which will have 1 shareholder, the trust, 3 board members, of which the client is chairman, and 3 officers, a CEO, president, and secretary. The trust I mentioned is going to be either revocable or irrevocable. Revocable is often referred to as living and is more flexible, where an irrevocable is less flexible but offers more protection in the case of a lawsuit. In conjunction with the trust, we advise a pour-over will, which allows ownership to transfer uninterrupted in the unfortunate case of a client's death. Pratt & Lefevre Corporation designed this strategy to ensure our client's business and legacy are structured to remain intact for future generations. This trust is the only shareholder of the corporation and is also one of the members of the LLC. The LLC is the suggested second layer in the Own Nothing, Control Everything strategy. Establishing a multi-member LLC is critical to ensuring that the entity is not considered disregarded or an alter ego by the IRS. Our recommendation is 3 members: the trust, the client, who will be the LLC's general manager or president, and their spouse or trusted partner who will serve as secretary. This will make up the 2 to 3 officers of the LLC. We do adamantly suggest 3 officers for both the corporation and the LLC to reduce the risk of impasse when it comes time to vote. The LLC exists only to hold assets and rent them to the corporation. To say it another way, the corporation rents all of its assets from the LLC. An easy third layer can be added for increased tax maneuverability and furthered arm's length protection in the form of a DBA or ABN. And at the core, of course, is the client or individual. So, to break it down, we recommend a corporation for your publicly visible protective layer, an LLC, which is invisible to the public and contracts only with the corporation, an easy third layer that offers even more maneuverability and protection, and the trust, a layer for arm's length control, a tool to ease the transfer of ownership should the need arise, and an integral component in eliminating the pain of probate.
That's cool. That explains it really well.
Structuring is highly important, and in the case of layering, your structures must work in harmony through strategic cash flow. Remember, if there are no asset transfers, there is no strategy. I want to emphasize that because the asset transfers are the key that unlocks the strategy we're talking about today. This is how it works. The client or individual has assets such as home and office furnishings, computers, electronics and related items, tools, equipment and related items, automobiles, and homes or properties. Our trained team of legal processors take all of these assets and transfer them from the individual to the LLC. This asset transfer may include management contracts between the client and LLC, marketing and management contracts between the LLC and corporation, auto and equipment rental agreements between the corporation and LLC, bills of sale for all assets, property rental agreements, HUD settlement statements, installment land contracts, wraparound contracts to carry loan obligations, and the funding of the corporation, LLC, and trust. Once the asset transfer is complete, the cash flows from the public to the corporation, which pays and deducts as business expenses any acquired overhead, including contracted fees to the LLC, as well as the client's once personal expenses like rent or mortgage payments, utilities, vehicle maintenance or repair, gasoline, auto purchase interest, and even credit card interest. Using these contracts, we guide the cash flow from the corporation to the LLC, which eliminates dividends and with them the concern of double taxation. The LLC then pays and deducts property tax, auto tax and registration, and any overhead accrued by servicing the corporation. Even more can be deducted in the form of asset depreciation. Once the LLC has paid its expenses, the cash flows either to the easy third layer for management service provided to the LLC and then to the individual or client who owns the DBA, or it can flow directly from the LLC to the individual. Thank you for taking the time to watch this video today. Small businesses.
So this is just somebody that I worked with for over 10 years. He owed the government money. And this was the first year that he did not pay taxes. Yeah.
I met him, or I'm friends with him, but I saw him last week and he said he got paid, the IRS paid him money back, where he's been paying taxes for 10 years.
Yeah, so that's when it gets exciting, right?
Right.
So this is what this looks like, right? And I'll talk a little bit about when they talk about asset depreciation. So this is just if you've got a car, just one car, your home, say your home's worth around $500,000. Okay. So depreciation, just with that, very vague, but that's $32,000 that you probably are not working with. and taking off. So there's two kinds of expenses to a business. Okay. And the best kind of expense is the one that is not taking money out of your checking account. We call those, right, non-cash expenses. That's what depreciation is. Okay. So if you think of that, you would be able to take $32,000 out of your business as an expense, but it's not taking cash out of your business. It makes it a lot more fun doing business, right? Here's another gal. She, the same thing, was stating that she paid taxes, and what's hard is it was just her and her husband, older couple, and they get hit with a $2,000 extra that they have to pay. This year it did not happen. They actually also got a refund. So again, we just talked about depreciation. So these are kind of the takeaways. So right now I want to ask you, the own nothing, control everything is, are you utilizing your house? And how that works is that we transfer bill of sale, your home, your autos, your furnishings, your electronics, everything to that LLC. The LLC then rents it to you and rents it to your business. Now it is considered a business expense, right? And because the LLC is a rental, it can write off the insurance, the taxes, the mortgage, the utilities, everything. And that's where it's called own nothing, control everything.
And that's what the wealthy do. This is what anyone that's wealthy, that's why the rich get richer, the poor get poorer, because we don't know these things. So good.
Thank you. I wanted to just share, I've got a company or a gentleman that's talking to me that owns a trucking company. We all know that if there's ever a wreck, a truck always wins. A semi always wins in a wreck in that.
Yes.
So, but his corporation will not own the truck. The LLC owns the truck and the trailer, rents it to the corporation. The corporation, again, owns nothing, but it controls what it's doing in business. So anyway, so that is basically what it is. And here's my information. And thank you, Amanda, for letting me come on today. And I did it a little bit faster than I thought I would.
Good job. Give her a hand. Give her a hand. All right. So 801-824-0774, Leesa at leesamyers.com. And then you will have do you have a free consultation with people?
Yeah. So we go through and just find out kind of what it is. I show you the suggested setup, but it's a whole different mindset, as you know, Amanda.
Yes.
My husband is still learning from me as well. Every time he goes to get gas for the car, it's like, okay, now which card am I using? Is it the corporation card? Is it the LLC, or is it our personal card? So Amanda, I'm going to give you a quick quiz. Okay. Right. Okay. So you are going to go to, let's say, Walmart, because in Mesquite, basically that's what we have. Okay. Or you're going to send your husband to Walmart. We'll send the husband to Walmart.
Yes.
Okay. So you send that he first needs to get gas in the car.
Yes.
When he goes to Walmart, you tell him that you've been looking at these draperies for your house. So you want him to pick up those draperies. And at the same time, you need him to pick up some milk and some eggs and so forth. Okay.
Okay.
Got it?
This is my test. I'm ready.
Okay. So when you go to the groceries, or when he goes to get gas for the car, which card is he using?
Corporation.
Good. Yes. When he gets to check out and he's checking out and buying the draperies for the house, for the home, which card is he using?
LLC.
Exactly. And then the groceries, who pays for that?
Personal.
Yes. So it's a whole different thing of looking at stuff. But when it starts to come together and you get those refunds, it's well worth it.
Right. It is a mindset shift. There is a lot to set up, but it just makes sense. It makes a lot of sense. Why wouldn't Why don't people do this already? It's because they don't know. They don't know what they don't know. The cost of not knowing is costing people millions of dollars year after year after year, compounded over decades. So highly recommend, if you want to learn how to structure your business so you could keep more money and have those shelters legally and profitably, I would reach out to Leesa. So thank you, Leesa, so much for being here. Give her a hand.
I appreciate it. Thank you.
All right.
I'm gonna jump off. So you have an amazing day, everyone.
Thank you. Bye.
Bye.